The US Navy just took control of strategic silver shipments, not inspections, not delays, active interception and rerouting under national security protocols. And if you think this is about trade policy or some bureaucratic formality, you've already missed what's actually happening. This is about supply chain capture at the sovereign level. And it's happening because industrial silver demand has crossed a threshold that makes it a strategic asset on par with rare earth elements and semiconductor materials. The gap between paper silver prices and physical delivery prices just hit triple digits in certain markets. And that spread is not noise. It's a structural fracture that reveals how broken the pricing mechanism has become. If you're not subscribed yet, hit that button now because we're about to walk through exactly why this matters and what it means for the next phase. Let me be very clear about what's driving this. Silver isn't just a precious metal anymore. It's a critical industrial input for defense electronics, solar infrastructure, EV charging systems, and next-generation battery technology. The Department of Defense has been running procurement stress tests for 18 months, and those tests revealed something that sent shockwaves through logistics planning. Domestic silver supply chains cannot support a sustained industrial mobilization without imports. That dependency created a national security vulnerability, and vulnerabilities get addressed through control mechanisms. The Navy's involvement isn't symbolic, it's operational. They're ensuring that physical silver destined for U.S. industrial applications does not get diverted to higher bidders in Asia or locked into financial settlement contracts that delay physical delivery. Here's what most people completely miss about this situation. The silver market operates on two entirely separate layers that have almost nothing to do with each other anymore. Layer one is the paper market. Futures contracts, ETFs, and allocated accounts that trade at prices determined by leverage, sentiment, and technical positioning. Layer 2 is the physical market, actual refined bars moving through vaults, smelters, and industrial supply chains. These two layers used to stay roughly aligned because arbitrage kept them connected. If paper prices diverged too far from physical, traders would buy the cheap one and sell the expensive one until prices converged. But that mechanism requires delivery. It requires the ability to convert paper claims into physical metal and move that metal where it needs to go. And right now, that conversion process is failing. The failure isn't sudden. It's been building for 3 years as industrial demand accelerated faster than mine supply could respond. Global silver mine production peaked in 2016 and has been essentially flat since then, despite prices rallying. Why? Because silver is mostly a byproduct of base metal mining. Copper, lead, zinc. You don't open a silver mine, you open a copper mine that happens to produce silver. Meanwhile, solar panel production alone is now consuming over 150 million ounces per year. And that number is growing at double-digit rates as every major economy races to meet decarbonization targets. EVs, 5G infrastructure, defense electronics, they're all pulling from the same supply base. And that supply base isn't growing. This creates a mechanical problem that has nothing to do with investment demand or sentiment. Industrial users need physical silver. They can't use futures contracts. They can't use ETF shares. They need refined bars delivered to their facilities on schedule. And when physical supply gets tight, they do what any industrial purchaser does. They pay premiums over spot price to secure delivery. Those premiums started small, 5%, 10%, normal market friction. But over the last 8 months, those premiums have exploded. In certain Asian markets, physical silver is trading at $28 per ounce, while COMEX futures are still under $30. But the delivery premium to get that silver out of a vault and onto a ship is running $4 to $7 per ounce, depending on quantity and timing. That's not a premium. That's a completely separate price discovery mechanism operating in parallel. Now, here's where the Navy's actions become critically important. The US government is watching foreign industrial players, specifically Chinese solar manufacturers and Indian electronics firms, pay whatever premium is necessary to lock up physical supply. They're watching US refiners get outbid for metal that's sitting in domestic warehouses. They're watching supply chains that are supposed to be secure instead getting price rationed to foreign buyers who can afford to pay more. And they're realizing that in a genuine crisis, a Taiwan scenario, a Middle East energy disruption, anything that requires rapid military-industrial mobilization, the U.S. could find itself unable to source the silver it needs for defense production because the market already sold it to someone else. That's unacceptable from a strategic perspective. So the solution is straightforward. Intercept the shipments, redirect the flows, ensure that silver coming into or moving through U.S. jurisdiction gets allocated based on national interest rather than pure price signals. This isn't a nationalization. It's not a formal embargo. It's selective application of existing emergency economic powers to prevent strategic resource outflows during a period of heightened supply risk. And it's legal. The Defense Production Act gives the executive branch enormous latitude to prioritize defense-related procurement, and silver absolutely qualifies. given its role in everything from missile guidance systems to communications hardware. But here's what this reveals about the actual state of the market. If physical silver were genuinely abundant, if the paper price actually reflected available supply, none of this would be necessary. Industrial users would just buy at spot price and take delivery. The fact that governments are now intervening in physical flows tells you that the paper price is completely detached from physical reality. It tells you that the pricing mechanism has failed. It tells you that the entities who understand supply dynamics at the highest level believe we're moving into a sustained shortage that cannot be resolved through normal market mechanisms. Let's talk about why this shortage is structural rather than temporary. Silver demand is growing because of technological necessity, not speculation. Solar panels need silver for conductivity. There's no substitute that works as well at scale. EVs need silver in charging infrastructure and battery management systems. 5G networks need silver in antenna arrays and circuit boards. These aren't discretionary uses. They're engineered into the technology. You can't build a solar panel without silver any more than you can build a semiconductor without silicon. And every government on Earth has committed to massive build-outs of exactly these technologies over the next decade. On the supply side, there's no response mechanism. You can't just open new silver mines. The economics don't work because silver prices would need to be materially higher to justify standalone silver mining projects. But the market keeps suppressing price through paper selling whenever it starts to rally. The result is that we're stuck in a doom loop. Demand keeps rising, supply stays flat. Inventories keep falling, but prices stay suppressed because the futures market allows unlimited selling of contracts that will never be delivered. That works fine until industrial users start demanding physical delivery and realize there's not enough metal to go around. That realization is happening right now. And when sovereign governments start intervening to secure supply, it sends a signal to every other industrial purchaser. If you do not lock up your silver now, you might not be able to get it later at any price. That creates a scramble. And a scramble in a thin market creates price explosions. The $100 gap referenced in the analysis isn't speculation. It's what happens when paper markets and physical markets fully decouple. Right now, if you want to buy a futures contract representing 5,000 ounces of silver, you can do it at $29 per ounce. But if you want to take delivery of that 5,000 ounces and actually move it to your facility, you're going to pay $35 to $38 per ounce after premiums, shipping, and insurance. That $6 to $9 spread is the market screaming that paper and physical are not the same thing. Now extend that logic forward. If industrial demand keeps accelerating, if government interventions become more frequent, if refiners start prioritizing domestic customers over international buyers, that spread doesn't shrink, it explodes. Physical silver could easily trade at $50 or $60 per ounce, while futures contracts still settle at $32 because the futures market is a casino that has almost nothing to do with actual metal delivery. This is the part that's truly dangerous for anyone holding paper-silver exposure thinking they're protected. ETFs, allocated accounts, futures contracts, they all rely on the assumption that you can convert paper claims into physical metal at the stated price. But if governments are actively controlling physical flows, if refiners are prioritizing strategic customers, if shipping and insurance costs spike due to geopolitical risk, that conversion becomes impossible. You're left holding a contract that says you own silver, but you can't actually get the silver. And when enough people realize that, when enough industrial users panic and start bidding for physical metal regardless of price, the paper market collapses into irrelevance. The timing of this matters enormously. We're entering a phase where currency debasement is accelerating globally. Central banks are trapped. They can't raise rates high enough to truly fight inflation without causing a debt crisis. They can't cut rates without reigniting inflation and destroying currency credibility. So they're stuck doing half measures that satisfy no one while fiscal deficits explode and debt to GDP ratios climb into territory that historically ends in either default or debasement. In that environment, hard assets with industrial utility become escape valves. Gold, silver, copper, lithium, anything with tangible use value and supply constraints becomes a store value that can't be printed away. Silver sits at the intersection of monetary asset and industrial necessity. It has the scarcity characteristics of gold, but the demand profile of copper. And unlike gold, where most of the above-ground supply just sits in vaults, silver gets consumed. It gets used up in solar panels and electronics that will never be recycled. That consumption creates a permanent draw on supply that compounds every year. At current consumption rates and production levels, we're burning through above-ground inventories at about 200 million ounces per year. That's sustainable for maybe 3 to 5 more years before available supply hits critically low levels that force either massive price increases or industrial rationing. The Navy's actions suggest that timeline might be shorter than most analysts think. Governments don't intervene in commodity markets unless they believe the market mechanism is about to fail in a way that threatens national interests. The fact that this is happening now while prices are still relatively subdued tells you that internal assessments show a severe supply crunch coming much faster than public data suggests. They're positioning ahead of the crisis, not responding to it. So where does this go? If you follow the incentive structures and mechanical constraints, there are only a few possible paths. Path 1, industrial demand moderates because of a global recession, buying time for supply to catch up. That's possible, but unlikely given that most silver-intensive technologies are backed by government subsidies and climate mandates that don't disappear in a recession. Path 2, prices spike violently to ration demand and incentivize new supply. That's the market solution, but it requires the paper market to lose control of price discovery, which is exactly what's starting to happen. Path 3, governments implement formal allocation systems where strategic industries get priority access at controlled prices while everyone else waits. That's the path we're currently on. None of these paths are good for anyone holding paper silver, hoping to convert to physical at spot price. And none of them are good for anyone assuming the futures market will continue functioning normally. What we're watching is the early stage of a structural breakdown in how industrial commodities get priced and allocated when supply can't meet demand. And silver is just the leading edge because it's small enough and critical enough that government intervention is both feasible and necessary. This isn't a prediction. It's mechanical analysis of forces already in motion. The Navy didn't just start blocking shipments on a whim. They did it because supply assessments show a problem that can't be ignored. And when governments start treating a commodity like a strategic asset, the price discovery mechanism shifts from markets to policy. That shift is happening right now in real time. And while most investors are still looking at spot prices, thinking everything is fine, it's not fine. The gap between paper and physical is the market's way of screaming that the system is broken. And the $100 spread isn't the end state. It's just the beginning of a repricing that reflects actual scarcity rather than leveraged paper trading.
Hello friends, welcome back to my channel and my new video. So friend, the US Navy just took a control of strategic silver shipments, not inspections, not derives active intersection and recovering under the national security protocols. And if you think this is about trade policy or same bureaucratic formality, you are already missed what actually happened. This is about supply China capture at the southern level, and it is happening because industrial silver demand has crossed a threshold that makes it a strategic asset on par with rare earth elements and the semiconductor materials. The gap between paper silver prices and physical delivery price just hit a triple digital in Saturn. In just hit triple digits in certain markets, and that spread is not noise. It is a struggle fracture that reveals how broken the pricing machine mechanism is become. If you are not subscribed yet, hit that button, not because we are about to talk to walk through exactly why this matters and what I mean for the next phase. Let me be very clear about what's doing the silver isn't just a precious metal anymore. So friend, thanks for watching and subscribe for more videos.